Moneycontrol. I'm Karunya Rao, and joining me today are two very special guests, one on the fundamental side, the other on the technical. We'll tell you how exactly should you trade or invest in the aftermath of US Federal Reserve raising the interest hikes. There's been a 25 basis points increase in the interest rate in the March meeting. There will be more this year as well. Powell has been very, very clear about how they want to curb and combat inflation in the months to come. But let's touch base with Arvind Chari first from Quantum to understand what it means for the markets. Arvind, typically, an increase in interest rate could lead to some divestment from riskier assets, whether it's commodities or even equities. How is this particular move of the FOMC likely to play out, and how will markets digest it?
If you see where we are starting and where we are heading, right? So I would think that the first 100 to 150 basis points of rate hikes by the US Fed, so from 0 to say 1.25, 1.5, should be treated as normalization, which is you had COVID, you had a extraordinary event, and the central banks reacted to it and took rates down, added liquidity. And as things have improved, so no economy is no longer in a crisis. In fact, many economies are actually running at a very high level. Growth has picked up quite significantly. And the central banks have to what we call normalize interest rates and normalize liquidity. So that is the way I see this from a fundamental perspective, that the first 150 basis points of rate hikes will be a way to normalize. And if you look at how the markets are priced, especially the bond markets, the US bond markets, they kind of already priced in this fact that the Fed fund rate sometime in 2023 will be to 1.5 to 2.5% in that range. Uh, and these kind of interest rate hikes, like the initial interest rate hikes from a low, generally tend to be good for equities. And we've seen that historically. You look at the 2002, 2004 cycle where the Fed had a very similar, uplift and, increasing from 1% interest rates to almost as high as 4.5. But the initial period in 2004-5, when there were growth impulse was very strong, where there was a broad-based recovery, where there was fiscal spending. The initial interest rate hikes was actually good. If you look at the market's response yesterday also, the fact that the Fed is indicating continuous rate hikes in 22 and 23, but has maintained 2023 GDP growth about 2.5%, if I get that right. And more importantly, they've maintained unemployment rate at 3.5%. So they're saying that we will hike interest rates by about 200 basis points, and growth will not suffer that much, and unemployment will remain as strong as it is today. That's a very strong signal from a growth perspective. So if you're a short-term investor, it's very different in terms of how you trade it. But if you're a long-term investor and you believe that economic growth will remain and sustain despite the Fed hiking, that's a good way to think about it. Of course, you will get volatility, and there'll be a lot of data points that will be very noisy. We already saw the Russia Ukraine have a very sudden impact on commodities and markets and pricing and valuations. And you will see much more of that, because after COVID, every central bank had a very similar action, which was to cut rates and add liquidity. Now, every central bank is acting on its own in terms of how much they will hike, when they will tighten, and how much will the interest rates go, and what is their inflation challenge. The Fed has a large challenge because their target is 2%, whereas they're currently at 6%. So they have a very wide margin. India is different. India target is somewhere between 4, 5, and 6, and we are at around that level. So every central bank will have different challenges and different aspects to normalizing interest rates.
To the trend in Indian markets, what about FII selling? Because high interest rates in the US results in foreign investors pulling out of emerging markets. So the trend that we've been seeing largely over the last many months of relentless FII selling, could that continue, or perhaps become worse than what it is?
I'll break that into 2, 3 aspects. The selling started somewhere in October last year, and then it's picked up quite significantly since then. Uh, it happened when the Fed kind of changed, and as the Fed commentary tilted towards high, inflation focused and inflation was not transitory, you saw some amount of FI selling. If you also see 2020 and 21 till October, the FIs were very large investors in India. So bulk of it drove it. I mean, this the Indian recovery was so much better and so much stronger than expected. People moving away from China because China was very in a very different regulatory environment in 2020, and people allocating more to India. So you might have seen a lot of short-term ETF passive investors coming in, and who are naturally as the Fed tightens, which is technically tends to be bad for emerging markets if it's very high, and you're seeing those kind of outflows. Other reason could also be valuations, right? India, even after the correction, was still relatively overvalued against other emerging markets. So, given the fact that maybe the large inflows in 2020-21 made funds and hedge funds and short-term investors slightly overweight on India, and they would have you know given the valuation, given the strong run-up in Indian equities and the liquidity that it provides to exit, they might have taken that exit and gone to some other emerging markets. We have to see how that plays out, because if you are a large investor, you can't invest in Russia today. You're finding it very difficult to invest in China in terms of a short term to long term. India then remains that large opportunity, right? So short term reasons have taken the money out. But if you look at the total outstanding investment, that's about whatever till December it was $650 billion of FPI money, and we've seen selling of about $20 billion. Maybe we'll see a bit more. But if the belief is that India is actually in a growth recovery phase, you look at different aspects of the economy, bank balance sheets, corporate balance sheets, government spending. The only thing that is kind of missing is demand recovery. The demand and consumer demand still remains constrained, but most other aspects of capex or investments or balance sheets, household, corporate, and government, they are in a much better situation. So uh, short-term FPI selling has been countered by domestic buying. If they sell more, maybe the market corrects more. But I think if you're a medium-term investor, I think these are very good opportunities. Like, yeah, in the last 2 weeks or since January, when the market has been correcting, at Quantum we've been investing. We've deployed our cash. We are still cyclically tilting the portfolio because we believe that but for this short-term oil prices and short-term correction and interest rate hikes, India should do reasonably well in this world, and the growth recovery should persist, which would mean that the earnings growth will remain and will be higher. You might see some short-term margin pressures in certain sectors, certain companies, uh, and you might see certain, as I said, volatility because of
Where do
what
you
the
see this pressure? Which sections of the market or which sectors?
So typically overvalued sectors. I mean, we've seen the correction that we've seen in, say, consumer plays, or price to price to perfection kind of sectors, right? We believe there is a lot more value in financials, in sectors like cement, and in auto. So that's why we are kind of cyclically tilted. So there will be volatility for that play, because as the market expects the Fed to do what it's supposed to do, and if Fed is actually more aggressive, and you get 200 basis points of rate hikes in 1.5 2 years, that will have pressure on emerging markets. But we've seen those periods before. My point is that in a 20-30 year Indian cycle that we've seen these periods of very high inflation and a very aggressive Fed, and the Indian markets have kind of managed it over a period of time. So of course, short term there will be
Okay.
volatility. Medium term, I think the outlook is much better. Till the time we say oil sustains at $150, that's a short term, medium term macro problem for India, because we are a net importer. Or the global inflation problem is such that that which was in the 70s, and the central banks have to react in a very strong manner to get economy into recession to counter it. Those apart, I think we are still in a better situation than before.
But will we continue to be in the better situation? That's the question, because we are slightly behind the curve,
Yes,
if we compare it to what's happening in the more developed markets in the West.
yes,
But
yes.
if one were to, invest in a market like this where there's a lot of uncertainty, there will be further raising of interest rate hikes. There's also talks of, you know, reducing the $9 trillion balance sheet by the Federal Reserve. There is
Yeah.
inflation. There is an ongoing war-like situation. Tell us, how should an investor invest? What should be the different asset classes or the different sectors that one can focus on amid all the uncertainty and turbulence?
So you should very clearly assume that the RBI will also what we call normalize monetary policy, right? So you should expect Indian interest rates to go up. We've been expecting it for some time. It hasn't happened yet. But as you said, looks like the RBI is reasonably behind the curve in terms of normalizing its policy. Forget about rate hikes to manage inflation. We are not even talking about that. We're talking about the reverse repo rate is 3.35. Average long-term repo rate has been at 6%. Even if you want to get at 5%, you need to start indicating that the rates will be higher and longer. I think that is coming. In the next policies, you will get the RBI talking about rising interest rates. So when rates are going up, the best way to play that from an investor perspective is to be in very short term debt fund assets like fixed income. So liquid funds, money market funds, because as the interest rates go up, you keep getting slightly higher rates. Bulk of the money remains in savings account. So over the last 2 years, savings and liquid funds had like there was literally no difference in returns. But as rates go up, savings rates won't move. Short term FD rates won't move that much, but liquid fund, money market funds will go up. The other way to play it is the longer end of the bond market is already priced in reasonable amount of hikes, right? So but for if oil goes to $125 and stays there for 3-4 months, the a mix of liquid fund, and as rates go up, as bond yields go up globally and in India, you should allocate more to say a short term fund or a dynamic bond fund. So that's the way to play it in fixed deposits or fixed income. In equities, it is it always depends on your allocation, right? From an individual perspective, I would always say that when the markets correct, given how underallocated broadly average Indian is to equities, it is always a good way to start building that allocation to your long term wealth creation. So keep taking the advantage of if this volatility of Fed and interest rates and oil prices gives you a opportunity to the equity markets correct, valuations get a bit attractive. I think it is only a chance to keep increasing. I'm not talking about short term. So short term, if you're already allocated, then it might be difficult depending on what liquidity needs you have and what risk appetite you are carrying. But you have to just believe in the fact that the Indian growth story is a long term story, and any opportunity, any correction, given the cycle that we are in, given the fact that we still believe this is for India, it's a reasonably strong economic cycle. It is an opportunity to keep investing. In
All
terms of
right.
the other asset class would be gold. So
Right.
when the Fed hikes and as real interest rates move from negative to positive, generally tends to be negative for gold from a price perspective. But the way to think about gold has always been that it is your portfolio insurance for equity product, and especially people who are fancy about Bitcoin and cryptocurrency. You've seen that as the S&P 500 corrected, so did Bitcoin, whereas gold didn't correct, or gold held it, or gold went up. So if you're looking for that diversifier of volatility or diversifier from stupid central bank actions or government policies, that remains gold. So you might not get a lot of movement from the current levels, but gold looks attractive from the fact that there is still uncertainty, as you pointed out. There is still volatility. You've still not got out of COVID. You've still not got out of the Russia Ukraine situation, and there is an inflation problem. So so always have that whatever 5, 10, 10, 15, 20% allocation to gold.
All right, Arvind, great chatting with you. Thank you so much for putting things in perspective and telling us how the FOMC's decision and commentary could impact markets at large and, of course, domestic equities as well. Thanks for joining in. Let's now touch base with Ruchit Jain of 5 Paisa as well to understand how the technicals of the market are looking. Ruchit, hi. Thank you for joining in. So,
Very good morning, everyone.
a positive open in store for Indian equities then. No surprises from Fed.
Yeah, so I believe that somewhat it's the hike which has been done that was already factored in by the market. So market usually do not react to things that that are already expected on the street. And if you look at last few trading sessions, so many traders who are on the short side have been trapped, and they are looking to cover their positions since the market has sustained above its resistances of 16,800, and now even 17,000 have been crossed. Even yesterday, if you look at some of the data, then the rise in Nifty was coupled with fall in the open interest. We had open interest decline of about 7% odd, which clearly indicates that the shorts have been covered. So this is a short covering, and I think as of now the momentum still continues to be on the positive side, and 17,300, 17,330 technically, which is the 61.8% retracement of the recent correction, that seems that could be tested in very short term.
So I'm sure all of our viewers would want to know which are the stocks or the pockets of the market that look exciting at the current juncture.
Yeah, so there are two. I think there are two groups within which the stocks can be divided. One is those stocks which had not corrected in this recent correction in the broader markets. So those were the outperformers, and now when we are seeing a buying interest coming in, so those outperformers are showing a good rally. And second is those shorts, those stocks which have seen very recent amount of short positions which have corrected very sharply and have come near the support level. So that stocks are witnessing some short covering moves. So I think the first group, which where I said that there was outperformance during the market fall, as they are approaching their previous highs, they are witnessing good buying interest. So I think that's that kind of stocks could give some good outperforming moves. So amongst that, Trent would be the first stock which I would recommend to go long on. We have seen a good consolidation in the stock. The previous highs in the stock have been crossed. So the downside here seems to be very limited at current levels around 1240, 1250. No, for short term, Trend could be bought with a stop loss below 1180. We expect targets around 1400 in near term. And amongst the short covering moves, which I've said, the stocks which have come near the supports and have short positions, cement is one space where yesterday we witnessed good short covering, and even some long formations were seen in the large cap cement names. So I think Ultratech cement within this space looks quite good, where I think the worst has been done. So Ultratech cement could be bought at current levels for about further 3 to 5% of moves.
Okay, great then. But if we look at the market levels, yesterday we had a great run. Benchmark indices clocked in nearly 2%. All the sectors were participating in this up move, and these last few weeks have been very volatile, of course, as we all know it. One day you would see a 1.5-2% uptake. The next day or the next 2-3 days will be followed by some amount of profit taking or correction also in some cases. But how is the trend looking like right now? Are we now steadily on the way up, or could there be further more, some more pain or some more volatility before we become meaningfully stable?
Yeah, so no, I think volatility was more because we were more dependent on the global moves, the factors that were there, the Ukraine-Russia war, then the rising commodity prices. So I think those had much impact on our markets, and that's why we have seen very high volatility recently. But of late, if you see last few days, India VIX have started coming down, which was around 30, 32 range. That is now that is now below 24. So I think if VIX subsides and it sustains below 22, that would bring in more stability in the market. And what we can see on the weekly charts, things were quite oversold, and markets have formed a very firm bottom at the recent close of 15,670. So already we have seen a good V-shaped recovery in last 1.5 week. And now what would happen that whenever the next dip would come in the market, traders would look for some buying opportunities over there, because the worst has been factored in over here. The major events, I think, such as Fed, which traders were looking for, it is behind us. So going ahead, we believe that this gap up, gap down openings which we have seen recently, I think we won't see such a big gap ups and gap downs on alternate days since the VIX would subside, and any declines towards that 16,800, 16,900 range would attract good buying interest. So the downside from here seems to be very limited, and any corrections, and I thought those should be used as a buying opportunity. We believe that the broader uptrend have resumed after this corrective phase.
Okay, but what about territories that still look very volatile or risky. Any stocks or any sectors perhaps that you would like to flag off to refrain from to our viewers at the current point in time?
So I think in the retail, what we are witnessing that traders are more attracted towards mid cap and the small cap names. But whenever you see when the market, the first leg of market rally after it bottoms out, that starts with the large cap names, and then it is followed by mid cap and later on by by the small cap names. So I think as of now, the focus should be on the large cap and some of the specific mid cap names where I think the outperformance would start coming in. And as far as sectors is concerned, banking in the financial space I think has been on the driver's seat in leading this pullback move. So last few days where there were shorts, we have seen that shorts have been covered. So banking and financial, I think one would be one space, which traders, short-term traders should look for buying opportunities. Apart from that, even auto names have witnessed a good correction. Since the commodities recently have seen a very sharp uptick. But now with the cool off in the commodity prices as well, I think the auto space would again witness some good buying interest. Stocks such as Maruti, Hero, Motoko, which have seen decent correction and are now trading around the mid to long term supports. I think these offer good buying opportunities over there. So one should be specific. Banking and financials, auto would be the names where one should look for buying opportunities.
Okay, well, that sounds good. Thank you so much, Ruchit, for joining in for a quick chat on how to position, one's trades right after the FOMC commentary and the stocks that look attractive at the current juncture. Thank you once again. Great chatting with you. And to all the viewers of Money Control, have a great trading day. Thank you so much for tuning in.